all intelligent investing is value investing. And when you have intelligent buyers facing intelligent sellers, you get great price discovery. But when you have these, auction-driven markets, which is the NSE or BSE or New York Stock Exchange, you will get much wider swings. And so if you're in the business of investing where you are dealing with auction-driven markets, just this phenomena of the 50% swing means at some point the stock is mispriced. It has to be either underpriced at some point or overpriced at some point, because the real value of the business cannot change 50% in a year for most businesses. So hence we have proved that there is always value in investments and markets.
In Rule 1 investing, we have 3 different methodologies that we use to value a business. We have the margin of safety, which Phil wrote about in Rule 1 investing. We have the payback time method, which Phil wrote about in his second book, Payback Time. And we have the 10 cap, which Phil wrote about with his daughter Danielle in Invested, his third book. All 3 of those valuations we believe work, except they often are used for companies at different stages of their life cycle. And so if you're looking for younger companies that maybe have a lot of high growth and they're putting all of the money they make back into their businesses, the margin of safety valuation works really great. And so Netflix is one of my favorite companies, and I think it is a Rule 1 investment. And Netflix has really high growing revenue, really high growth earnings, but they spend all of their free cash flow and earnings on growing the business. And so the margin of safety valuation would be the one we would use when looking at Netflix, versus PayPal is another really great company that I think is doing amazing things in the world. And they are a free cash flow machine. And they've been growing their free cash flow at 13 to 15% for the past 15 years. And so looking at PayPal, we might be able to use a payback time valuation, which focuses on free cash flow. And then the 10 cap, which is our favorite valuation of the 3, only because it's the easiest valuation of the 3 to do. You simply just have to look at the company and say, hey, is this company going to be bigger and better in 10 years? It doesn't matter what the growth rate is. It just has to be bigger and better in 10 years. And so if you look at a up-and-coming company like Sprouts Farmers Market that is focused on reducing food waste and providing customers organic and ethically sourced grocery food, you look out 10 years and you say, are they going to have more stores than they have today? And the answer is yes. They're going to have 1,000 stores in 10 years. They only have 400 today. And right there, you know that you can use a 10 cap. You find the owner earnings and multiply it by 10, and you've got your valuation. If I had to simplify value investing, I often like to look at real estate. I think real estate's a great way that you can identify with a wide range of people. Most people, that are coming up in their, late 20s and 30s have bought a house at some point in their life. And you've had to ask yourself, am I paying a good price? And so if we're looking at value investing and the Rule 1 investing, on buying a house, let's say, we would want to find a wonderful house that's in a great location. And we'd want to look at what that house could produce us in cash flow if we were to rent it out. And then we'd want to buy it at some price where we got a really good return on that money. Let's say 10% or better return would be the starting point for a house. And so you go out in a market and you find a house that is worth $500,000. You want to make sure that that house at a minimum can make you $50,000 a year in profit as your starting point for being on sale. And if you can do that, you will be a really good Rule 1 investor, because that is a screaming deal in real estate. They call that a 10 cap.